welcome everybody to our investment update, our halftime report with Balance Wealth. We're really excited with this being our first webinar as the combined team with Bolt and Balance. So for today, we'll have Nick Gukin, our Chief Investment Officer, and then also Shaun Carney, partner and CEO here at Balance Wealth. We're excited to just talk through what's going on in the markets, what they're seeing, and we, of course, always want your questions. So as Nick and Shaun go through this, and I'll chime in here and there, right, just for fun. As they go through it, if you have any questions or want them to expand on any points, please feel free to add it into the question area down at the bottom. It should be an opportunity to just kind of type something in and ask questions. But I'm going to go ahead and let Nick get it started and take it away. But thanks everybody for being here and hope you enjoy it.
Cool, right on. Well, thank you, Bob. Yeah, we are definitely looking forward to going through everything tonight. We have a lot to discuss, not 2 hours worth. We have it limited, but plenty to talk about. And yeah, excited to have Shaun on the panel with me this go round. It'll be great. So just from a high level, thank you all for joining. One of the main things that we wanted to accomplish with this is helping you guys filter through all the noise and the news. It's been a very busy 6 months, 7 months here in 2025. And kind of our mantra for the investments is to make sure everything we do is simple, explainable, and aligned with your values. So today, the webinar, we're really just going to try to help digest all the economic data and just make sure it's simple and explainable and as easy to digest as possible. So without too much else here, we'll hop right into the stock market update, because that's the part that is usually most exciting, that we all want to talk about. So yeah, this chart I think sums up 2025. We've been anything but quiet around here, and if you've flipped on the TV and happened to catch CNBC or CNN or Fox or whatever, you've probably seen one of these headlines flashing across the page, and the talking heads just hammering them nonstop. So there's been plenty to talk about. This is a chart of the S&P 500 and how it's done year to date. And so you can see all the green dots were new all-time highs. We've had almost 10 or 12 now all-time highs. And then the red dots were the lows for 2025. So kind of a narrow window of time for the lows. But still, we saw some major volatility, some major drawdowns, and some big headlines like Israel attacking Iran, treasuries, inflation, all the things. So our focus here is to help you make sense of all this. And don't worry, I'm not going to go through each headline if that's what you're worried about. Just wanted to summarize it all into one page here. So go ahead, Shaun.
I would love to go through every headline because and I won't. Don't hold your breath. But ultimately, this is what we hear on the news all the time. And so, there was a time period from about February 19th through about April 30th that the market was pulling back, and it felt really scary. And we had people calling in like, "Can we do something different? Right? Do we run to cash? How do we adjust the portfolio?" And our story has always been, our portfolio is built to be able to get through these times. And 2025 seems volatile. 2022 with rapid interest rates, rising inflation, that was scary. 2020 with coronavirus, restaurants being closed, that was scary. Certainly go all the way back to 2008. And if we look at that, the green dots point out every time there's been a market high, there's always been another market high. So we're here to help kind of coach you through some of that volatile times, and ultimately stay away from some of the headlines. Always give us a call, because we don't want you making drastic changes, because the news cycle is really scary, right? The data supports staying invested. That's how you maximize your wealth. Despite all the headlines, and in just a short 7 months here, you can see there's plenty of headlines to talk about. So just want to kind of highlight that point.
Yep. Perfect. Cool. So how has 2025 shaped out versus all those other years and times that you mentioned? I believe it's the fastest. I was looking up all of the different drawdowns and market crashes, meaning the market fell greater than 10% and then bounced back up on the recovery. 2025 is the fastest recovery that we've seen on record, where it bounce back in just 80 days. It's been, not to minimize it, like Shaun said, like it was scary and it was stressful for clients. Like it's one of those parts of our job. Like we don't love the volatility. We never love down days or red days. If in a perfect world, we would, want everyone's accounts to just go up every day. But we know that that's just not the way it works. But the best thing we can do for y'all as advisors is to coach you along the way, keep you invested, and just present the data to help you make the best decisions. So,
Mhm.
yeah, I
And
know.
I think too, one of the things to highlight was, and we talked about it a lot, was 2018. We saw the Trump tariffs play out. We saw that 18% crash, and you can see that one on the third line there. And we
Mhm.
said, we've seen this playbook before, and they bounced back. It happened again February through April. We said, we've seen this before. We never know how long or how far it's going to drop. And certainly the tariff talks this time were harsher than last time. But we said, let's stay invested. We know it's going to come back. And certainly it came back really quickly. We are not through the tariff talks, as we'll get into today. But ultimately, if they do pop back up and it gets scary again, we just want you to remember 2018, the first half of 2025. If we stay patient, as Nick highlighted, we'd love to say that if we're building a portfolio for someone for a 6 to 8% return, we'd love for it to be linear and it go up by 7% every single year. But that's just not the way it works. It's going to bounce around, and we have the data. Hopefully, you have the trust in us to know that, hey, we've done the right things. We have a diversified portfolio that's seen these volatile markets. Therefore, you can stay invested during turbulent times.
Yeah, yeah, absolutely. All right. So, we're just peppering y'all with numbers today. So this is it's called a quilt chart or carpet chart. And I know we've gone through this one before, but this is just highlighting not every asset class, but just some of the major asset classes in the market and showing how well they've done relative to each other and so far year to date. So, and then the white box in the middle is just kind of a generic 60-40 portfolio. So you can see how that's fared through all of these market conditions over time. And the goal with the asset allocation or the diversified portfolio is so that way you're not swinging from the top to the bottom every time. Like you kind of smooth out the experience and have less of a roller coaster effect versus putting all your eggs in one basket. And that's the same message that we have today. So the asset allocation portfolio, diversified portfolio, has actually held up really well. Stocks and bonds are positive this year. Year to date, international stocks have done great, but last year they were one of the biggest laggards in the portfolio too. So that's exactly why we don't, put all the eggs into one basket, and we're here to rebalance across these things and just keeping invested the whole way. So, okay.
And I think on that kind of international front, one of the big things that's happened this year is we've seen the dollar get weaker. There's a lot of reasons that's happened. The Trump tariff discussion has created some geopolitical tension and uncertainty. We've seen countries kind of pull out of a lot of our bond positions, and therefore it's weakened our dollar. So the reason that is important is because if I had bought a Starbucks coffee here in the US for $10 or whatever they're charging these days, it would cost me $10. 2 years ago, if I went to Europe and bought that, it might only cost me $8 because the dollar was so strong. I had to spend less US dollars to get that coffee. Whereas fast forward today, where we've seen the dollar lose 15% of its value this year, now to get that same $10 coffee, I have to spend 12 US dollars. So those international companies are getting more US dollars, which is boosting their balance sheets. So it's showing that they have a really good return this year because they're making more dollars. So that's one of the things as we get into some of the Trump and the macroeconomic policy that has played out through 2025. And the key thing we want to highlight there is still Europe has a lot of regulation, right? There is no Google or Amazon or Meta that's been created in Europe that's created their kind of boost and return. It's been a simple macroeconomic policy where we see the US dollar get devalued. International's done really well, and it is kicking the US's butt this year. It's up about 16 to 17%, where the US is up about 5% for the year. So international has been the best performer year to date. And that's one of the reasons that's kind of occurred so far this year.
Yep. Yep. Absolutely. All right. So we'll keep rolling on here. We're going to pivot back to the US and the S&P 500 because that's one of the easier benchmarks that is just flashed all the time in the news, but also one that's in most of our memories for a benchmark. And to all the folks that I've shown this chart to before, here's an updated one year to date. And I love this chart. It shows the annual returns are the gray bars of the S&P 500. This is going back the last 45 years. And the red dots are the intra-year decline in the market. So over the last 45 years, there's not a single year where there's not a red dot, right? Like there has been drawdowns every time, even with those strong double-digit returns. And that's just honestly the price you pay. Like you stomach the red to earn the gray bars. And 2025, shakes out, and it every time there's a drawdown, it feels like, oh no, this time's different. And the data says this time may be different, but it's really not that different as far as the market volatility is concerned. And so the drawdown we felt this year, again, not trying to minimize the stress and scare that it caused, and a lot of our clients anguish, like nobody likes to see their accounts go down. But we know that staying invested in the long run is the winning formula. And despite all those drawdowns, 14% was the annual return over the S&P over this time frame. So rocking and rolling if you don't jump off the roller coaster. Okay. Cool. Keep chugging along here. So I don't know if you guys saw the headlines last night and, just scour earnings reports like we do. It's a very fun hobby. But in case you missed it, some of the Mag 7, the Magnificent Seven, started to report their earnings for the quarter, and they absolutely crushed it. Like, I think Microsoft had like $5 billion of additional earnings than expected. That's an insane number to overachieve on. And I like to show this chart because it's actually kind of a misnomer. The Magnificent Seven is this collection of some of the 7 biggest, hottest tech stocks today. And the chart on the left, pulls that basket of 7 back through 2021. But in 2021, they weren't called the Mag 7. They were called FANG. It was like 4 or 5 stocks. And then it was FANG with an extra A and an extra N. And then it was FANG Plus. And so the hottest stock basket definitely changes over time. But the essence that it's trying to show is that 2025 has been an interesting year. We've actually had more earnings from the remaining 493 companies in the S&P 500, where as previous years, almost all the returns are being fueled by these tech stocks. So this year's been good. Like other sectors have done well. And as we look forward, going over into the chart on the right, we look forward into 2025 and 26, you see the blue bar, which is the S&P excluding those tech stocks, starting to catch up on earnings. And I think like the biggest reason for that, in my opinion, is that these players, these companies are all some of the biggest movers in AI, the artificial intelligence revolution that we're in. And so they caught the early wave of the earnings growth, and they're still honestly in the early stages of all that. But as we see AI trickle into all the other sectors and industries, we'll start to see the productivity gains and boosts and additional profits coming from those other areas too. So the initial wave starts here, but there's still good news on the horizon as far as earnings growth for the rest of the market in double-digit territory forecasted into 2026.
And I think too, something that's important to highlight is, as Nick did, right? The Magnificent's changed. It's been FANG Plus, but it used to be ExxonMobil and Kodak and IBM. So we don't want to go chasing the top stocks that are in a portfolio, right? Or you go to the water cooler at work and people are saying they're buying, Tesla or whatever it may be. We get a lot of those questions like, what stock should I pick? And it's almost impossible to guarantee that right return. What we do know is the Magnificent Seven's changed names, it's changed companies, it's changed industries, and so we don't want to go chasing returns because it's very easy to say, well, last year they got 48%. Let's put all my money there. Because in 2022, they lost 40% versus 8%. And so, in order to get some of those wonderful returns, you got to be willing to stomach the really bad losses. And we don't know, right, if the Magnificent Seven is going to remain the Magnificent Seven, or if there's a new company that comes out that is the leader in AI and becomes bigger than Apple, right? Those are things that no one knows, and we're not going to try and predict that.
Yep, that's a great point, Sean. I'll just throw in my 2 cents, right? Like this is whenever we look at these like Magnificent Seven or they talk about it and it was Fang or whatever, it's always backward looking to say, hey, look what did happen. And they don't know, what those groups are going to be, but the market will tell you. But if you're just staying invested in a nice diversified portfolio, you are going to be a part of whatever that next Magnificent Seven is going to be, right? But if you try to pick it, that's where you may miss it. You may get it wrong. And so it's much easier to just, hey, let's stay diversified. Let's have a, balanced portfolio of, good allocation versus trying to pick what are the next seven going to be.
Yeah.
And regardless, right, when we buy the S&P 500 or we buy a total US stock position, your money is in the Magnificent Seven, right? It's in there in a very crafted, smart, intelligent, diversified way, rather than trying to overweight something, trying to chase returns.
Yeah, yeah, absolutely. You guys hit the nail on the head with that one. So I think we'll put the Mag 7 to rest for now. We'll keep going here. Let's talk about something way more exciting than the Mag 7, which is bonds. Okay. Bonds are honestly one of my favorite areas to talk about. It's the boring, stable returns. But this year, finally, we're seeing rosy pastures, green pastures for the bond investors. The 40 and the 60/40 is performing really well. We're up almost 4% midway through the year. And this is just the aggregate bond index. So just kind of a core bond portfolio, up 4% halfway through the year. I mean, we're on track for a 7-8% return on the safe money this year. So like that's amazing. And we're happy for that because bond investors have certainly been put through the ringer the last few years. Cool. Bob, you had something to say there?
Yep.
No, you just love bonds as well. Okay. All right. Cool. So pivoting to what is one of the biggest drivers in bond returns and was also on the headlines last night, in case you missed it, was the Fed meeting. And so the Federal Reserve chairman, his name's Jerome Powell, and the Fed is this government agency that controls the short-term overnight lending rate in the US, which is bunch of jargon to say they essentially control the one interest rate that dictates almost all other interest rates across the world. And as you can see here by this gray line, we have what's called the flexible monetary policy, meaning that the Federal Reserve can flex the interest rate down to make conditions easier when times are tough, and they can ratchet it up if things get too easy and there's a lot of inflation. So they can increase interest rates to kind of fight that. And so as we look back over the last 20 plus, I guess almost 30 years, 93 there, this has been anything but a flat line, right? Like we've had lots of volatility in interest rates. And most recently, we plateaued in 2024. We did a couple of cuts, brought it down from 5, and we're sitting around 4.5 right now. And the long-term goal for the Fed, according to them right now, is this purple dot, which is 3%. Now, the cadence on which they get to that 3%, going from 4.5 to 3%, is honestly anybody's best guess. That's what all the gray area and all these other dots are. Nobody really knows when they're going to be able to do that. According to the meeting last night, it didn't sound like they were super excited to cut rates in September, which is their next opportunity. But, there's still a lot of data that can come out to change their minds. So, yeah.
And I think it's also in that press briefing, some news came out. There are actually 3 members of the Federal Reserve that kind of went against the status quo and said, hey, I think we should cut rates. Ultimately, Jerome Powell, right, is the decision maker. But that was the first time we've seen dissent amongst kind of the Federal Reserve that openly and that strongly. So does that lead to potentially September being a rate cut now that we're seeing kind of some differing opinions within the Fed, right? Kind of some unique news that's different from the last couple of years. And we're going to highlight the kind of the 2 key data points that will give us more information on what the Fed's going to do. But I think from an investment standpoint, what I really want to highlight is if you look from 2008 to that 2022 mark, you can see how low that federal funds rate was, right? And that's when your savings accounts were earning you 0.25%, and it made no sense to keep money in savings. Since 2022, we've seen that federal rate go up. And we've also seen high yield savings accounts exist. Those have had more value. So people have been putting money in a high yield savings account, which makes sense. Safe, liquid, it's finally giving you something. But as we see this rate come down, we're going to start to see those savings rates come down as well. So one of the things we want to monitor moving forward is it time to get that money back in the market rather than having a high yield savings account? Or are banks going to continue to try and be competitive and give you good savings rates in your savings account so they can manage more money, right? All why that's important. Another thing I want to highlight is this is not directly correlated. It is correlated, but not perfectly with, kind of home interest rates, car loan rates. That's going to float more year on the 10-year treasury bond rather than just this rate. So oftentimes we're getting questions like, well, the Fed's lowering rates, but mortgage rates aren't coming down. Well, because they're not perfectly correlated. Okay. So this does not necessarily perfectly tie to home loans, auto loans, all those things. We're going to be looking at the 10-year treasury bond to kind of see how that movement's been going on.
Yep. Yeah. And yeah, that high yield savings account was certainly attractive at 5%, still attractive in the 4-ish% range right now, but will get less and less attractive as it drifts lower here. So we'll see, where it lands and how slow they go. So just as a quick reminder though on how interest rates and bonds work in general, it's largely, like, not 100% of the time, but it's mostly attributed back to this teeter-totter effect on the left. As interest rates come down, which is in the scenario that we're at, like we're flat / hopefully down later this year, what that normally does is going to push bond prices up. And again, bond investors have already, even though there haven't been cuts this year, like already chugging along at a good rate, like I said, but there's cuts, then we could see, really nice returns in fixed income. So the chart on the right shows how some different asset classes have performed a year after the Fed resumes the rate cutting. And so cash, the one in orange highlighted, that's that like high yield savings account. Again, it's still a positive return. Like, you're not losing money on cash. It's just the yield is going to drop. And it gets less and less attractive the lower it goes, obviously. But just US bonds, core bonds on average, about 7.5%. Like I said, we're at 4% year to date in July. So that's, pretty dang close. As is, and could be another 7-8% return year in bonds over the next 12 months too. But then also just stocks, like just lump all these together, call it like a global portfolio. On average, not only double-digit returns, but 20% returns over the following 12 months after the Fed continues the rate cuts. And funny, I had this chart made, I think on like Monday, to highlight this part here that markets are currently expecting 2 rate cuts before the end of the year, with the first one in September. After Powell's speech this week, he really didn't sound excited to cut rates in September. So not saying it won't happen, it's anybody's best guess, but there's less and less optimism that rate cuts are happening quickly this year. So as I pivot on here, this table's a new one that I wanted to highlight. It's like, man, we have a lot of clients like, I wish the Fed would cut rates faster, right? And that's certainly what Trump has been pounding and hammering in the news. Like, calls him too late, Powell. He wants the interest rates cut yesterday. And the data for this, though, is really interesting. So if we look on the right side of the slide here, if you look at the light blue bars, that's when the Fed cuts interest rates quickly. And when they cut rates quickly, how does the S&P 500 or the stock market perform 3 months, 6 months, 12 months after? And it still has been positive, right? But relatively muted returns, versus when the Fed cuts rates slowly. That's when you see like these really huge returns in stocks. And part of the reason for that makes sense, right? Like, when there's a recession or economic crisis and the Fed pulls out the interest rate card and lowers interest rates to save the day, it's usually because there's a financial calamity or catastrophe going on. And so it makes sense that the stock market doesn't just magically have 20% gains in that environment. But in the environments where growth is still good, unemployment isn't crazy, and you're just battling inflation, the S&P actually does really well when the Federal Reserve lowers rates more slowly. So even if you're a fan of Trump and cutting rates quickly, the slow cycles have been good historically. So, okay. All right. So now stocks, bonds, we're going to pivot to the economy overall. And we have some good stuff here to make economic numbers as exciting and as fun and engaging as possible here. So just to kind of summarize it, this is not every economic data point, but this is just kind of an overall scorecard of some of the main things that go into the health of an economy. And the first one is GDP growth, and that's growth in the total gross domestic product. So right now, the latest number that came out in Q2 is hovering around 3%, which is phenomenal. Anything over 2% is like great for the US. And it's especially great when it's not a negative number. So we're growing the economy, it's above 2%. That's a solid number. I'm going to wait to go into all of these other data points here, the inflation and unemployment rate. But overall, everything is in like the good to fair condition category, I would say, except for the consumer confidence. And that number is based on the University of Michigan Consumer Sentiment Index, which is a very well-respected survey in the financial community. But it's a survey of 500 households to represent a nation of 330 million people. So take that for what it's worth, grain of salt. And also, whoever they survey, typically they're very optimistic if their political party's in charge versus if their political party's not in charge. So that number can swing a lot just depending on that sample size. Okay. All right. So quarterly GDP growth. So part of the reason we had that big drop in April was everyone was freaking out, not only about the tariffs, but also about the GDP or the economy overall contracting. And not only that, we were also worried that we would have two contractions in a row, which equals a recession. My wife just gave birth to our second son, so talking about contractions in a row is kind of, second nature for me right now. But yeah, the good news is Q2 was a very positive, like I said, 3% number. So like that's phenomenal. That's the annualized rate here. So economy's humming along just fine. We don't have this major, we're not like in a, terrible spot right now as far as that's concerned. There's been a lot of delays in tariffs and all these other things. So there's, a lot of people are like, oh, well, that's not including future impacts of tariffs, but so far so good year to date. Okay.
So
All right.
this is, one of the numbers that we're going to talk about. I think that's really important with the Fed rate decision is going to be the inflation and the unemployment number. So this is going to be our consumer price index or a measure of inflation. We just want to kind of show you here is going back a year, inflation kind of came down, it bounced back up, it came back down through the first part of this year, and the latest number showed a tick up to about 2.7.
Mhm.
So inflation has kind of been all over the map. If you remember back to 2022, it guys had 9.1. So it's
Mhm.
been decreasing. The Fed wants to see this number at 2%. So when they see kind of an upturn in this graph and inflation rising, they're going to be less likely to lower the interest rate,
Mhm.
right? Because they want to keep that interest rate high so people quit spending money, right? Quit putting in indoor or outdoor pools and all that stuff. They want to see people spend less money, inflation get down to that 2%. That's a really, really big target of theirs. So as we saw that number come down from 9.1, markets rebounded, did well. We see it tick up. We see the market get a little scared. So this is one of the key indicators of the Fed making a decision on lowering the interest rates and some of the data that Jerome Powell is using before he makes that decision. So on the next slide, right, that is the Federal Reserve's number, right? That's the government produced number.
This one.
Trueflation, yes, yeah, that one. So this one is Trueflation, which uses kind of some more real-time data, some other different data sources to produce a inflation number. And what it's showing is that, hey, inflation's coming down again. Okay. So again, we don't really know until we get the next report next month on what's happening in July. But the true inflation report saying it could be coming down again. So again, that leads us to a higher likelihood that the Fed would lower rates in September. So just want to kind of point that out. And the
Yeah.
next one gets a little scary when we add it all up.
Yeah, so this again is the true-flation number, but it's basically right on top of what the government inflation number has been. But really, like 28%, this is looking back through January of 2020, so right before COVID hit. What has been the cumulative amount of inflation that just in general that goods have gone up since January 2020? And it's almost 30%. Like we've lost almost a third of our purchasing power since January 2020 as Americans. And so that's big, and that's a scary number. That's a number that we all feel, right? Like just on literally everything, cheeseburger, like going, buying anything. And so this is the number, like when we talk about inflation going from 9% to 2%, like that's not deflation, right? That rate that we're talking about is still a positively growing rate. It's just growing at a slower rate. And so the Fed's goal is not to create deflation. It's not to actually lower prices. It's just to slow the increase. And I think that's an important thing that we get lost in our minds. We're like, oh, the goal is obviously to bring prices back to where they were, right? It's like, that's not even the goal. Like if that happens, then honestly, somebody made a mistake somewhere along the way. And, you know, that aspiration that we have as people, as humans, to go back to these lower prices, it's really, really unlikely that that happens.
And not
And
just
I think
unlikely, what you alluded to a little bit, Nick, not just unlikely, but it would be a bad thing if it went back, right? I think, for all of us, I remember putting a quarter in the, Pepsi machine or whatever to get a can of Coke, but, now you got to you got to scan your, Apple Pay or whatever to pay $2 for a thing of Coke now, right? But
Mhm.
we're not going to go back to where those prices were, even though it might make us feel better or think like that, or it's some of the rhetoric that we hear political side, either side kind of talking
Mhm.
through. The goal is just slowing down inflation so that the economy keeps growing. Things are going to cost more tomorrow than they cost today, but this also leads to why we stay invested, right? Why we keep investing, because we have to outpace this. We have to continue to grow our money so that we can continue to buy the things that are going to cost more tomorrow than they
Mhm.
do today.
Yeah, yeah, absolutely, absolutely. So I'm going to keep humming along here. So that's inflation, pivoting to one of those next data points that goes into the economy. Take it away, Shaun.
yeah, so this is the other big number, right? So it's inflation. We want to see it around 2%. And this is the unemployment number, which is a very healthy, strong number. And you
Mhm.
can see this number is at 4.1%. It's remained that way since 2021. So we
Mhm.
have had a strong labor market for a long time. The
Mhm.
Fed, if this number goes up, we would say, okay, people are losing jobs, companies aren't hiring. How do we incentivize them to do so? We would lower rates. So if we
Mhm.
see an uptick in unemployment and a decrease in inflation, the Fed would be more apt to lower rates. So
Mhm.
again, kind of the two biggest data points you can see 2020, right? That was that coronavirus thing that impacted everybody's life, right? We saw unemployment as high as 15%. Go back to 2008, the Great Financial Crisis, we saw unemployment around 10%. Look how long it took from 2008 to 2017 to get back to that 4% range. So the things we did during coronavirus to get it back down they worked, and it's remained steady. We're continuing to monitor this number to say if we start to see unemployment go up, bad signs for the economy, the Fed may lower rates there, or they'll say, hey, we have a strong labor market, inflation's back down to 2%, let's lower them anyway. But we
Mhm.
don't believe, right, unless we go back to 2008 and see that unemployment number remaining at 10%, 8% for a long time, that we're going to see an interest rate environment like we did in 2008. We're getting 0.25% in your savings account. You're buying homes for 2.75% to 3.25%. That's not a normal market. The reason it happened was 2008. Now we're going to get back to kind of that new normal, as Nick highlighted. They'd like that federal funds rate to be about 3%, ideally, for their target.
Yeah, yeah, absolutely. Cool. Yeah, it's almost hard, like the folks that really want there to be an interest rate cut are almost cheering for like a spike in unemployment, right? They're like, that's all we need to get an interest rate cut. And so it's kind of bad. Like the Fed is in a weird position where like they're almost waiting for the American economy to show cracks before they lower rates. But they're not necessarily like the bad guys or the villains in the story. They've done a pretty good job overall of handling the current situation, in my opinion. So,
And I also want to highlight too, other countries across the globe have cut their rates. Their inflation's got more under control than ours. So
mhm,
it is different by regions, different by countries. We've seen Europe already cut the rates. Another reason that they're having a wonderful year is their inflation got more control than ours did. So different countries, different rates were going to be produced by their Federal Reserves.
yeah, yeah. All right, so pivoting to a little bit more on the geopolitics side here, but this chart shows the effective tariff rate on US imports, so stuff going into the United States, and how that tariff rate has floated over time. And so I think it's great to show Trump's first administration in here when tariffs rates went from like 2 to 3%, and everyone was freaking out and calling it a trade war. And like I heard the word trade war like a million times in those couple years. And then this go around, he came out swinging, threatening the orange line, which is obviously quite dramatic compared to both his first administration, but also just historical normal. But currently today, like that's where, the market crashed in April or crashed, bounced down in April was because this was the fear that he was going to lock in with this. And as we sit here and this was June 30th, July, things have developed a little bit, very fluid situation, obviously, but the in general effective tariff rate is hovering around 15%, not 30% for most countries. So still, exponentially higher than where it has been, but not at the 30% level that we started the year with that kicked off all those recession fears.
And this is the conversation we were having back in April was like, hopefully it's a negotiating, strategy, right? Maybe this is data to show it was, but still a very large increase. And so the news cycle now has been talking about, is that going to cause more inflation? Is that why we saw a tick up last month in inflation, right?
Mhm.
All things that we don't necessarily know, but want to kind of provide some data behind what's actually happening.
Yeah, yeah, absolutely. So, on that note, I wanted to pull up Trump's economic playbook. And I think this one's important to touch on, even though this is a market update slide, just because this has been a huge driving force in the economy. And there's been a lot of things that the Trump administration has done. On this presentation, we're just focusing on the economic playbooks. We're not going into any of the social mandates or anything like that, just trying to keep it purely through the economic lens. What's been going on, what are his moves, and just trying to help you sort through all the noise in the media about like what's actually happening. So, and again, we're not saying, let me also caveat this, we're not saying this is good or bad. We want to present the information, and then, a lot of you already have your own opinions about this, and that's totally fine. Honestly, the short answer is no one's going to know how effective this playbook is till years in the future when we can look back and be like, oh yeah, that was good, or oh yeah, that was terrible. And so hang with us here. We're going to just lay it out as plainly and simply as possible for you guys. Okay. All right. So what is this playbook? For the critics of Trump, they think this is his playbook, like a blank slide, just a bull in a china shop, like no plan whatsoever. And honestly, like the opaqueness of the negotiations and all the things, like it feels like this, like he's not being super transparent about how every single negotiation is shaken out in real time. But the first part of his playbook that we have seen, and also with the passage of the OBB, the One Big Beautiful Bill, is that one of the biggest pieces of his agenda is tax cuts, deregulation, and moving the economy in a way that entices international investment to move their manufacturing to the US. Also, he would love low interest rates to be lumped into that category. If he could control interest rates, that would have been in the one big beautiful bill, I'm sure. Like create stimulus for a very pro-growth, for a pro-business environment. That is the main goal, the main essence. Like if I had to summarize the OBB, that would be like a huge piece of it. Like the purpose of making, and it's not even like a bunch of new tax cuts. It was more like the majority of it was just making the old tax cuts permanent per se. So it's not necessarily like a huge move or as big as a move as it might sound. But overall, that's a huge piece of the playbook. I'd say that's probably the first play in his playbook. Secondly, and we just talked about it on the last slide, but is the tariffs. And even though tariffs have stolen a lot of the headlines, it's honestly just been one piece of the negotiations. And so, like one of the most recent examples that we just saw with the European Union is, for them to have favorable tariff rates with us, they had to agree to essentially reroute their supply chains through the US versus getting their energy from Russia or China or their cars from China. They had to like guarantee or commit to buy US autos and US energy. And that's how they got to XYZ tariff rate. And so it's a big complex equation. It's not so simple as just like, yes, tariff you, no tariff you, and not just like made up numbers necessarily. There's a lot of complexity that goes into it. And even though tariff is the one buzzword that everyone likes to use, it's just been one piece of the overall negotiations. So, all right. And the last piece, and if I had to summarize all of this playbook, is the last line there, but it's essentially that the US will grow at a fast enough clip to actually create a surplus because we're still running at a deficit, our economy, meaning that the government is spending more money than it's taking in. And so Trump's big bet here is that the tax cuts and the stimulus will create enough growth to actually create a surplus to then whittle away at the debt. So if to put it mathematically here, $1 of tax cuts equals $3 of new growth or $5 of new growth or some greater number than one of new growth. And the big deal here is that we have no idea how this is going to shake out. And we won't know, there's no way to measure this in real time. Like the effect of tax cuts are not necessarily like immediate. Sometimes they take quarters, years to trickle into the economy. So again, we're not saying this is good or bad or different. We're just trying to lay out like what the plan is and what has been going on and transpiring in the economy so far this year.
And
So,
I'll highlight as an economist,
mhm.
right? You could get all these smart economists in a room, and they would say one side would say this is good, one side would say this is bad, right? These would be the most brilliant PhDs from Harvard and Yale and all that. And there's also economists, especially like the Booth School of Economics in Chicago, that macroeconomics doesn't even matter because you can have this great playbook, and if we go to war with China, then throw it out the window. We don't know if it worked, and we don't know if it's going to work in the near term. Right? Is the increase in GDP this quarter because more people are buying U.S. products? Is it because our dollar is cheaper, so they're getting cheaper products here? Does it play out that fast, or does it take 6 to 7 years? And by the time that happens, there's a new administration that came in and completely changed this whole thing. So there are a lot of economists that don't believe that macroeconomics matter at all, and there's also really smart economists that agree and disagree with this. And so we are not saying this is right, wrong, or indifferent. It's just this is what we believe he's trying to do. And these are the intended consequences that he's hoping for. Who knows how and when that will show up?
Yeah, yeah, absolutely. So just to, beat the dead horse a little bit more, his playbook, like wanted to clarify for each point, like what the supporters say and what the critics say. Because I think a lot of our clients, like they may or may not listen to just one news source, and it's good to hear the other side. And I think a very clean, concise table format will help just make us just aware of like what the other side is feeling and thinking in the country and why they might be so polarized on some of these things. So tax cuts. So the supporters say it'll boost investment in the US, like from foreign companies, right? Could boost wages, and they're like, oh, it'll just pay for itself with all the new growth, right? The $1 of tax cuts, $3 growth. The critics say, and all the financial models say, it just immediately adds to the US debt. And the tax cuts that happen are skewed toward the wealthy, like the SALT cap, moving up to $40,000, like things like that, skewing toward the wealthy. And so, again, we won't know exactly how that shakes out. Deregulation, so that's peeling back laws and rules that can create environments for businesses to innovate and grow more quickly. Overall, this is mostly aimed at energy and manufacturing in the US. And so the critics say that this will increase different various risks, right? Like, pollution being one, but also financial instability. Like a lot of people look at like the Silicon Valley Bank crisis that happened in 2022 as a result of deregulation. So there's certainly two sides to that argument. Tariffs and trade. So the supporters say it's just a negotiation tool, can protect US workers, and can reduce deficits. Like I think Trump was, talking this week about how much money the tariffs have brought in, like 150 billion so far this year. But the critics say that it can raise prices, right? It can increase the inflation number in the short run. It can actually slow growth, and it disrupts our normal allies, both like trading allies and military allies likewise. And then lastly is the growth bet. So it's the $1 tax cuts, $3 of growth. Critics say historically that playbook has not necessarily panned out like in a super, obvious way where there was previous tax cuts equaled this much growth. There's always like we have one of the most large and complex economy. So like it's really hard to isolate the causes and effects when things happen. So the historical data that we do have doesn't necessarily show that it's worked in the past. That doesn't mean that's not going to work this time. These are different tax cuts, different types of deregulation, all the things. But the main point is that nobody knows, right? Exactly how this is going to shake out at the end. But this is what's been going on politically here in the US from the economic perspective. So.
Yeah. And
All
I'll
right.
kind of highlight these are the news cycles that you're
Mhm,
feeling, right? And everyone's talking about that creates that fear. And what
mhm.
we want to say is no one really knows. What we
Yeah.
do know is that if you build a diversified portfolio and you stick with it, it's always gone up. Every time there's been a market high, there's been another market high. So we can ignore kind of all the headlines, know
Mhm,
that a lot of smart people disagree on this.
mhm.
And a lot of people agree that if I build a diversified portfolio, it's going to grow. And that's ultimately our main objective.
Yeah. Yeah, absolutely. Not letting political affiliations impact when you're invested. There's a chart, it's the one chart I'm missing from the slide, but it shows the S&P over the different presidential cycles, and it looks almost like a linear line, right? And it's just flickering from red to blue over the different administrations. So, yeah, absolutely agree with you there, Shaun. So, all right. Hopefully, we got some questions from y'all through that. And if not, I'm sure Ryan can make some up for us here. But
Well, I don't have a question, but I did see a little bit of news came up while you were presenting, Nick, that Trump hikes tariffs on Canada to 35% and ups rates for dozens of countries. So even while we're talking, as Nick alluded to, it's a fluid situation. So,
Mhm,
while and listen, we said this in a number of ways. I've said it to, since I've been doing this, and I will continue to say it for as long as I continue to do this, that the news cycles are going to just print these headlines and try to create an emotional reaction to what's happening because fear sells, right? That's what they're trying to do. And so when something comes out, and these tariff numbers are really big, it's going to spit out an alert to you and say, hey, this is what's happening. But I think what we try to share here is there's a lot going on, but we want to try to stay kind of long term looking in this while understanding what's happening in the short run.
yeah, yeah, absolutely. Absolutely. Well, thanks for watching our webinar and not the latest headlines, like Bob was.
We did get one
So-
question here.
All right, cool.
So haven't we already experienced the fact that trickle-down economics don't work? Is that your growth bet box?
I mean, I would say that it's not a clear case that it doesn't work, right? Like one argument is the greatest argument for trickle-down economics is the fact that the Fed exists and we all feel it when rates move, right? Like that's a macroeconomic decision that impacts everything cascading down to it. So that's kind of one category. As far as the trickle-down economics as directly related to tax cuts, like there's studies that show that it has been successful in some ways, maybe limited capacity. Like I said, most of the data shows it hasn't been like super obviously successful, right? But that doesn't mean that this time might be different, right? That's what the Trump supporters would say. Like this time's different, and so we'll see how that all shakes out. I mean, I would say the only other like most recent example of the trickle-down economics is what's been happening in Argentina with Javier Milei, and they drastically cut government spending and taxes significantly, and their poverty rate dropped by like 70%, and their overall stock market was up over 130% last year just in Argentina. So like it does happen in different cases. Obviously, like our economy is far bigger and far more complex than Argentina's, but to just do a blanket statement and say it never works, I would disagree with that.
Well,
Yeah,
and just one comment that I'll throw out there. Sorry, Shaun, I'll let you
you're
jump
good,
in
you're
here
good.
too. But
Mhm.
this is why generally I am a believer in investing in the long term, and I'm an optimist from a capitalistic society perspective, right? Because if we continue to grow, if we continue to have really smart people that solve complex problems for the world, that they are incentivized to do that by, the kind of the ability to make more money, what that does is it makes everybody's lives better, right? So, from the healthcare that gets passed around to the technology improvements to the overall standard of living that specifically here most of us have in the United States, but also any other first world country, like, not attributing it directly to, trickle down economics or anything like that, but just the focus on growth in a capitalistic society can help us bring people up that are the worst off and share that as much as we can, and how much we share is what's certainly up for debate, but I think that incentivizing folks to again solve complex problems is a good thing for the world as a whole.
And I'll piggyback on saying the the reason that there's so many economists that don't believe any of this matters is because if Trump implements all these policies and they all go, and a new startup comes out that's an AI guru, and they grow to be larger than Apple, and the economy grows because of it, is that because of the macroeconomic policy, or is that because there were a couple of great companies that were developed that really crushed earnings? No one
Mhm.
really knows what to attribute it to. So there's so many outside factors and we don't have a timeline that who knows what works and what doesn't. If it were pretty clear, then every president would come in and cut tax rates, and that would be the answer, and it's clearly not. That does not equal B. So it's a wait and see game ultimately.
Yeah, absolutely. Cool. Well, I'll go ahead and flash our disclosure slide here. So
Yep.
clients.
Well, and I'll wrap it up. And I'll wrap it up for everyone too. So I just want to thank everybody for being on here this evening. Nick, thank you for putting all this together and kind of running with it. Shaun, thank you for all of your commentary and helping kind of balance out, not to pun not intended, I guess, but helping balance out Nick as well. And we're hoping that you enjoy these. Please give us feedback for, what you think of these, things we can do better, things we can improve upon. And of course, join us next month. I will be discussing how the big beautiful bill impacts specifically Social Security, but kind of in general, kind of a tax overview. So that'll be something that hopefully you all find interesting. But Shaun, thank you. Nick, thank you. Ryan, thank you for being here and helping us just kind of navigate the tech side. But we hope you all have a great evening and look forward to seeing you next month.
Cool.
Thanks everyone.
Right on. Thank you.